Welcome everyone to our webinar where we share about managed portfolios or FSM MAPS for short. Yo Wei Ren, who heads our research team at IFAS Singapore and is a senior portfolio manager, will be reviewing the last quarter of 2021 and give direction to your portfolios for the year ahead. So we'll be sharing key investment themes that you should watch for this year and how you can position your portfolios. And he will also be providing an update for the performance of FSM MAPS and some of the latest portfolio changes. I'll now pass the time over to him.
Thank you, Sarah, and good evening, everyone. My name is Wei Ren, and I serve as a senior portfolio manager at iFast, and I'm also part of the team that helps to oversee the running of our FSM managed portfolios. So today, I'd like to just give everyone an update on the performance of our MAPS portfolios in 2021, and I'll also be going through our market outlook for the year ahead and how we were positioning our portfolios moving forward, and also an update on some of our recent portfolio changes. And the timing of today's webinar couldn't have been better because Russia has just invaded Ukraine and markets have been tanking like crazy today. So my slides were actually prepared way in advance before this latest escalation. I've tried to add in some slides to address this Russia-Ukraine issue, but it won't be able to cover all grounds. So I'll start off today by first giving everyone an update on the performance of our MAPS portfolios. So 2021 has been a very eventful year because the year was once again dominated by the COVID-19 pandemic as the new waves of Delta infections swept across the world and also forced countries to implement lockdowns and social distancing measures. And towards the end of the year, the discovery of Omicron added to fears that the ongoing economic recovery would be derailed. But despite the setbacks in our fight against COVID-19, global equities have continued to hit record highs in 2021, thanks to high vaccination rates across most of the developing world and also unprecedented stimulus measures. But having said that, not all equity markets did equally well in 2021. As we can see very clearly from this chart, the market rally was very uneven. On one hand, we have developed markets like the US and Europe leading the way in 2021. And on the other hand, we have markets like China that ended the year with very steep losses. And China in particular was on a different path compared to the rest of the world because China persisted with its COVID zero strategy, and they have also largely avoided the use of large-scale stimulus. And more importantly, China cracked down on its technology firms throughout the year in 2021. So it should come as no surprise that China actually ended the year as one of the worst performing equity markets in 2021. And in fact, if you look at the performance disparity between China and the US, China actually lagged behind the US equity market by more than 50 percentage points last year. So if you have been overweight China and underweight the US in 2021, then chances are your portfolio probably didn't do so well in 2021. And that was exactly what happened to FSM managed portfolios, because for those of you who have been following our investment views, then you will know that we have been bullish on China, but the significant underperformance of China as well as Asia and emerging markets in general. So this has weighed heavily on our performance last year. So if you look at this slide over here, which shows you our calendar year performance. So if you look at our calendar year performance for 2021, our MAPS growth portfolios have delivered returns of between a loss of 1.7% for the conservative portfolio to a gain of 8.7% for the aggressive portfolio in 2021. And as you can see also very evidently from this table, we have significantly underperformed our benchmarks, especially our aggressive portfolio, which was behind the benchmarks by close to about 10 percentage points. So last year, we were not able to build upon the good results that we have delivered in both 2019 and 2020. And our performance in 2021 also brings our, also means that our performance since inception it also means that our portfolios have delivered annualized returns of between 3% to 10.4% since the inception of our portfolios. So similarly, the performance of our MAPS income portfolios, it's also very similar to our growth portfolios. So for the income portfolios, we have actually delivered returns of between a loss of 2.1% for the conservative portfolio to a gain of 8% for the aggressive portfolio in 2021. And again, we have also significantly underperformed our benchmarks. And the reason for this underperformance is also largely the same as our growth portfolios. We were underweight the US and we were also overweight China. So that has negatively affected the performance of our MAPS income portfolios as well. And since inception, our income portfolios have delivered annualized returns of between 2.8% to 9.2%. So in terms of individual fund performance, most of our developed market equity funds delivered positive gains in 2021. If you look at this column over here, the one-year performance actually reflects the full year return for the individual funds. But unfortunately, most of them didn't do as well compared to their benchmarks, so they have not been able to effectively capture the strong equity upside in 2021. Our position in the JPM Japan Equity Fund, it was loss-making, and that's largely because Japan didn't do as well compared to the Western developed markets last year because of their slow initial rollout of vaccinations. And of course, our exposure to digital economy stocks using the O-Shares Global Internet Giants ETF. So this position was also loss-making. The sell-off in tech stocks in response to rising interest rates has affected the performance of this ETF. And the selling pressure was especially huge in the last 2 months of 2021. So for the full year, this ETF was actually down by about 7.5% in 2021. So for emerging market equity funds, they didn't do as well compared to our developed market equity funds. So for our Asia ex-Japan equity funds, it was, I would say, a mixed bag. You can see very clearly that most of them are in negative returns. But for our Asia ex-Japan exposure, you can see that the dividend strategies like the First State Dividend Advantage and also the Fidelity Asia Pac Dividend. So these two have been a lot more resilient compared to the growth-oriented funds, which tends to be more concentrated in the tech-related names that didn't do as well in 2021. And we also had a couple of funds that suffered steep losses, such as our exposure to Latin America, which was down very sharply. Largely because of a worsening COVID-19 situation, especially in Brazil. And inflation is also running high in this part of the world, and that has forced their central banks to hike interest rates very aggressively at a time when their economies still remain fragile and unemployment rates also remains very high. The UBS Greater China Equity Fund, it also suffered steep losses in 2021, and that was largely due to the regulatory crackdowns by the Chinese government throughout the year. The Fidelity EMEA Fund was perhaps the only exception over here because it delivered a very strong return of more than 25% return last year, largely due to 2021 being a good year for Russian equities, which is a big part of the EMEA equity space, and the recovery in energy prices has also contributed to the fund's positive performance. In terms of our tactical ideas, all of them registered positive gains in 2021. So the best performing of all is our exposure to the VanEck Vectors Semiconductor ETF. So this one gave us a total return of about 45%. So we have also included Blackrock World Financials Fund at the start of this year because of our view that financials will rebound in 2021. And this fund has also done quite well with a total return of 18.4%. And we also have exposure to China banks using this Hong Kong listed ETF called the China AMC Hong Kong Banks ETF. So this ETF's return was, of course, a lot more muted compared to the other two. It delivered a small gain of just 1.3%. But this 1.3%, it reflects the ETF performance only for the fourth quarter last year because we only added this ETF to our portfolios in late September. Bonds in general, it didn't do as well compared to equities last year. So the performance of most of our fixed income funds was relatively lukewarm in 2021. So we took a big hit in our exposure to Asian high yield bonds. So this one was down by more than 18% last year, largely because of the crackdown on Chinese property developers, which accounts for quite a big part of the overall Asian high yield bond market. So that's all for the MAPS performance review. So 2021 has not been an easy year for us, but 2022 has so far not been very kind to us as well, because market risks have been rising, and with so much uncertainty in the market right now, getting our asset allocation decisions right in 2022 is certainly not something that is easy. So over the next few slides, I'll be sharing with everyone our market outlook for the year ahead, as well as how we will be positioning our MAPS portfolios moving forward. So I think it's impossible to talk about 2022 without first talking about inflation. The Federal Reserve has for some time characterized the inflation last year as a transitory issue, but after several months of higher prices, there is increasing evidence that inflation appears to be sticking around and could last well into 2022. And it was only in December last year when the Federal Reserve finally stopped using the word transitory to describe inflation. And in December, they actually projected 3 interest rate hikes in 2022 to help bring down the inflation. But the Fed is clearly behind the curve because the markets have now run ahead to price in the possibility of 5 to 6 interest rate hikes this year, which we think is still not aggressive enough, given that inflation has been constantly above market expectations over the past few months, and doesn't look like inflation is going to decelerate anytime soon. All along, the argument for inflation to come down in the second half of this year is that as economies start to reopen, inflation is going to come down because consumers are going to spend more on services instead of physical goods, which has so far been the main driving force behind higher inflation because of all the disruptions to our global supply chains. But this argument also looks a bit shaky right now because evidence is now pointing at higher services inflation because of not just rising raw material costs, but there is also a chronic shortage of workers in the US especially. So services inflation has been steadily picking up at a time when goods inflation still remains high. And then now you potentially have higher energy costs feeding into this inflation, given the recent escalation in Russia and Ukraine tensions. So our view right now is that the Fed is likely going to have to hike rates more aggressively than what markets are currently pricing in. And this also means that 2022, it's likely going to be a very tricky year for bond investors because fixed income as an asset class, it tends to be very sensitive to interest rate movements, and it can be very vulnerable to price declines when interest rates move up. Now, what about equities? So will the Fed rate hikes this year cause a market crash? Well, not necessarily, because if you look back in history, there is evidence that equity markets can continue to do well, even in a rising interest rate environment. So for example, if you look at the rate hike cycle from 2004 to 2006, the Fed actually hiked interest rates for 17 consecutive times. But during this period, the S&P 500 still managed to deliver an annualized return of more than 10%. And also similarly, if you look at the rate hike cycle from 2016 to 2018, then you will also see that the S&P 500 has also managed to do well. During this period, it has actually delivered an annualized return of more than 9%. So there is no need for us to immediately reduce our equity exposure to prepare for Fed rate hikes this year, because equity markets can have the potential to do well even in a rising interest rate environment. And there are even sectors that stand to benefit from a rising interest rate environment, such as the financial sector, which we currently have inside our MAPS portfolios, and we will continue to maintain this position inside our portfolios throughout 2022. But of course, the change in the interest rate environment has already led to some sort of a sector rotation away from the tech sector, and this has weighed heavily on the performance of tech stocks so far this year. So the conventional wisdom is that rising interest rates will negatively affect technology stocks, especially those that are currently unprofitable or those that make very little profits at this point, because their valuations are based on future profit growth. And a higher interest rate environment will actually reduce the present value of those future expected earnings. So in short, conventional wisdom says that when interest rates rise, technology stocks will definitely go down. But the issue with this argument is that it is only true if you assume that everything else is constant. And in real life, that rarely happens. And if you go back in time, you will also realize that the relationship between interest rates and technology stocks is actually not that straightforward, because in the past, there are periods when tech stocks have managed to do well despite a rising interest rate environment. And there were also times when tech stocks didn't do well, even though interest rates were falling. So historically, there has been, I would say, no strong relationship between interest rate and tech stocks. And on top of that, the global economy, it's going to undergo rapid digitalization. And this is a trend that will not go away. This is a structural trend that will continue to happen, whether interest rates go up or down, which is why we continue to advocate for an exposure to digital economy stocks as part of an investor's core equity allocation. So instead of looking at interest rates, I think perhaps looking at the earnings potential, earnings growth, as well as valuations, I think these are more important metrics to focus on at this point. You just need to look at the huge sell-off in Facebook shares after they released their earnings results, which was surprisingly weak, versus the big rally in Amazon's shares after it has posted positive earnings results. So markets are increasingly less tolerant of earnings disappointments, and they are also more focused on fundamentals. So valuations is, of course, another important consideration. So when it's cheap, we should overweight the tech sector, and when it's expensive, we should go underweight the sector. So that's essentially how we have been approaching our allocation to digital economy stocks. And right now, we think that the valuations of digital economy stocks, it is still on the expensive side, even after the recent sell-off. So we have an underweight position for digital economy stocks. So if the sell-off continues, there will come a point when valuations will look attractive enough. And that is also the time when we will consider upgrading our outlook for digital economy stocks within our overall asset allocation. But at this point, it is an underweight position for us. So in terms of investment implications for our portfolios, I think first and foremost, at the asset class level, we do think that equities are the better place to be in at this point. And we recommend investors to be overweight equities relative to bonds for 2022. And like I said just now, equities have the potential to do well, even in a rising interest rate environment. And there are also sectors that can stand to benefit from rising interest rates. Fixed income assets, on the other hand, we think it will be more vulnerable, especially the longer dated bonds. And on top of that, in terms of valuations, equities are actually more attractive relative to fixed income. Now, if you look within the equity space, the US market is probably the only equity market that is considered to be very expensive. But outside of the US, there are still plenty of opportunities within the equity space. Asia is a good example. I think vaccination rates in Asia in general has been picking up, especially the Northeast Asian economies. And this will allow for a more sustained recovery of domestic demand. And there is also a gradual move towards endemic, especially the major ASEAN economies. And that also means that the likelihood of severe lockdowns is very unlikely. China is, of course, a big worry because the slowdown in its economic growth is something that the investors are concerned about. But the slowdown, it's currently at a point, it is currently at a level that policymakers can no longer ignore. And in fact, China has already started to ease their policy measures to help support economic growth in 2022. So there are still opportunities within the equity space, but fixed income is a different story because we are of the opinion that valuations in the fixed income space are getting a bit expensive across the board. And in terms of opportunities, I would say it is currently offering very limited value to investors. So our portfolios will be overweight equities relative to fixed income. And within equities, we are underweight the US, and that's largely because US equities look extremely expensive, both in terms of absolute valuations and also relative to other equity markets. Earnings growth is likely to have peaked in the third quarter last year. And with the market already pricing in a lot of positives, then that also means that our downside risks have also increased as well. So for this year, we believe that investors should expect low returns from US equities. And given that there are other more attractive regions to play the continued recovery, our portfolios will be underweight the US equity market. So Europe, comparatively, in terms of valuations, it is more attractive. It is a more attractive market compared to the US to play the recovery. It has a higher rate of vaccination compared to the US. And also policy-wise, it is also more supportive compared to the US. And despite the strong performance in 2021 for European equities, its valuations are also still within reasonable levels, especially when you compare against the US equity market. And on top of that, this is a very important point. European equities, they have long been seen as a value market that is heavily weighted to banks and also the old economy industries that could potentially benefit in a rising interest rate environment. So this macroeconomic backdrop could be supportive of European equities. But of course, at this point, the escalation of the Russia-Ukraine tensions, I think that is a risk to Europe especially. But we would like to urge investors to be calm at this point, because geopolitical risks, they tend to have a short-term market shock. Markets tend to sell off as the crisis unfolds, and then there is also the possibility that markets could rebound quickly in a later time frame. This was true in 2014 when Russia annexed Crimea. So there was a short-term sell-off in the initial stages of the crisis, but markets eventually stabilized. And we also need to bear in mind that earnings growth remains robust for many European companies. But the situation is fluid and could escalate further beyond our current expectations. So at this point, I think we are comfortable with a neutral weight for European equities. It's attractive in terms of valuations. Earnings is robust, but yet at the same time, market risk is starting to build up for this particular market. So I think a neutral stance is perhaps warranted at this point. Japan is a market that we think is starting to look interesting. Japan is in fact one of our most favored markets for 2022. We think it has the potential to catch up with its global peers this year. Now, the Japanese equity market has actually delivered a disappointing performance in 2021. It has largely lagged behind the US and Europe, and that's largely because of its slow rollout of vaccinations across the country. But this situation has changed because vaccine supplies have been rapidly increasing in Japan, and Japan's vaccination rate has accelerated very sharply, and it has now overtaken even the US and the UK, and these countries were previously the world leaders in terms of vaccinations. So with a higher vaccination rate, then this also paves the way for a more sustained economic reopening for Japan, and also a recovery of domestic consumer spending. Policy-wise, it is also going to be supportive. So the fiscal stimulus package that was recently announced by the Japanese government, so this should be a tailwind for the economy this year. And Japan also does not have an inflation problem like the US. If I can point you to this chart over here, if you look at the core inflation of the US, it is currently hovering at about 5%. But if you look at Japan's core inflation, it is currently at a much lower level. And there were also periods of time last year when core inflation in Japan was actually in negative territory. So this also means that the risk of Japan tightening its monetary policy aggressively is very low as we move into 2022. And Japan's equity market is, of course, very sensitive to global growth. So we think that it is in a good position to benefit from the ongoing post-pandemic recovery. And more importantly, if you look at market valuations, I think Japan's valuations, they are quite attractive, especially when compared to the US equity market. So I think in short, I would say the stars are quite well aligned for Japan in 2022. So we are overweight Japan in our MAPS portfolios. Outside of developed markets, there is also another market that we are particularly bullish on, and it's China. China is, of course, unlikely to engage in large-scale policy easing, like the kind of stimulus measures that we have seen in the US. But like I said just now, the growth slowdown is currently at a point where the government can no longer ignore. So moving forward, we can expect to see some policy fine-tuning and also incremental loosening by the Chinese government. And in fact, the PBOC, the central bank, has already delivered some supportive policy fine-tuning for the property sector by ensuring that there is continued access to bank lending as well as mortgage approvals for the healthy developers. The central bank has also been cutting its reserve requirement ratio in order to support the slowing economy. And our conviction towards China has actually increased since the start of this year, because the government has signaled very clearly that more easing measures could be implemented to help support the economy. And the statement from the Central Economic Work Conference, which is like a high-level government meeting that sets the economic priorities for the year ahead. So the statement from this meeting has provided a very clear signal that China intends to move decisively this year to stabilize growth. And the Chinese character for stability, the Chinese character is wen. It was actually used extensively throughout the statement. And I quote this particular statement. Okay, if you look at this particular statement and the number of times that the word wen was used in this one statement, a lot of times. 稳字当头，稳中求进，经济稳定，稳定宏观经济. In this one sentence, you can find the word 稳 in the sentence. So very clearly, China is now focusing on stabilizing the economy and keeping growth within a reasonable range in 2022. And we do expect China to roll out more supportive policies. Most importantly, I think the valuations of China's equity market, it is starting to look very attractive. After the crackdown that we have seen in 2021, I think investors have already priced in a fair amount of negative news. So from a valuation perspective, we think the Chinese equity market is attractive. And with the recent shift in their policy stance to an easing bias, then this could potentially be a catalyst for Chinese equities to do well this year. And also in terms of an easing of regulatory pressures on China's tech sector, we also do expect to see an easing of regulatory pressures in this sector. So investors have always been under the impression that the Chinese government wants to crush its innovative internet companies. Now, this is actually not what the government wants to achieve. And we have always been of the view that the intention of this crackdown is really to safeguard consumer interests, to ensure the sustainable growth of the sector, and also to maintain social stability. And we must also consider the fact that companies like Alibaba and Tencent, so these companies, they have been dominant in China's internet space for a very long time. But yet, since these companies were first founded, these companies, they have actually faced nearly zero antitrust regulation. So in the long run, if this is allowed to continue, then this lack of competition within the China's technology sector, it will surely discourage innovation in this industry. And this is important because this is a time when China wants to achieve technological self-sufficiency. So this is currently a top priority for the Chinese government. And if you look at it from that perspective, if you look at it from the perspective of driving and encouraging innovation within the tech sector to ensure that the country can achieve technological self-sufficiency, if you look at it from this angle, then the crackdown on the tech industry's antitrust practices, it is not entirely unreasonable. And there are also signs that the worst of the crackdown may be over, because the statement from the Central Economic Work Conference, it has actually toned down the language that was being used for tech regulations. There was actually less mention of the crackdown on big tech companies. And also, the long-term outlook for the tech sector is also positive. China is already one of the most digitalized societies in the world, but its internet market is still far from saturated and still lagging behind mature markets like your North American markets, as well as the European markets. So as China continues to invest in its internet infrastructure, especially in the rural areas, then we expect the internet market to expand further. Now, at this point, I think it is also worth highlighting that the big tech companies like Alibaba and Tencent, they remained at the forefront of innovation in China, and they will play an important role in helping China to achieve technological self-sufficiency. These national champions, there is no way that these national champions will be eliminated entirely by the Chinese government. And these companies, they themselves have also been aligning their company with government goals. So they have been investing in key strategic areas like cloud computing and semiconductors. So we think regulatory pressures could ease this year, and China's technology sector could see a turnaround in 2022. And I have one slide over here that compares the statement in 2021 versus the statement in 2022 on the part regarding tech regulations. So you can see it from the statement in 2020 that the language used was a lot stronger. So for instance, the use of phrases like strengthen anti-monopoly. So such phrases were being used in the statement, and platform companies was specifically highlighted in a statement. And then you also have phrases like unfair competition should be firmly opposed. So this was the kind of the tone of the statement that was being used in 2020. Okay, now let us look at the statement in 2021. So 2021 statement is a lot softer. So instead of strengthening regulations, it is not about strengthening supervision. So some commentators are saying that perhaps this could mean that the rules are more or less finalized already. And right now it's all about making sure companies play by the rules. So this leads us to think that perhaps we have already seen the worst of the regulation, and that sentiment could potentially recover in 2022. Could there be further regulations? Yes, definitely. We have already seen that over the past week when Meituan was asked to lower its fees, and Financial was being scrutinized again by the Chinese government. And there were also rumors that China could be facing additional crackdowns. What this means is that investing in individual stocks, individual Chinese tech stocks could be something that is risky in this kind of environment when you don't know the direction of policy and where you don't know which company is going to be hit next. But yet at the same time, if you want to participate in an eventual rebound in this particular sector, then going for a diversified exposure, such as the use of a unit trust, such as the use of an ETF, which we have inside our portfolio, I think that is something that is more something that I would prefer and would advise our investors to use in their portfolios. Okay, I have spent a lot of time talking about equity markets. For fixed income markets, I think with rate hikes coming in 2022, we think that global investment grade bonds, they are going to be very vulnerable, especially your developed market government bonds, given that they are very sensitive to interest rate movements, and their valuations are also expensive as well. So high yield bonds, they also offer higher yields compared to investment grade bonds. So comparatively, they are more attractive. But having said that, the valuations of global high yield bonds, the ones in US especially, so US high yield bonds, I think valuations are looking quite excessive at this point, because not only are we seeing record low bond yields, credit spreads in these regions have also tightened very substantially. So for emerging market bonds, we are also underweight this segment because this segment has seen a significant decline in yields and spreads over the past year. And more importantly, emerging market bonds, they come with high duration. So that also makes them very vulnerable to price declines when interest rates eventually go up. So which other fixed income markets should bond investors put their money in? We think investors should go for short duration bonds because these tend to have a much lower duration compared to, let's say, your longer dated bonds. And funds that invest in short duration bonds, they also tend to be less sensitive to interest rate movements because the proceeds from the shorter dated bonds that mature in about 1 to 3 years' time can be reinvested at higher yields in the future. So besides short duration bonds, I think another segment that we are particularly bullish on is Asian high yield bonds. So after the significant correction in 2021, because of China's crackdown on property developers, I think the Asian high yield market is currently offering investors a very attractive yield of more than 10%, which is currently the highest in the fixed income space right now. And the credit spreads of Asian high yield bonds, they have also widened very substantially. So this suggests that attractive value is starting to emerge in this sector. In fact, if you look at the current credit spreads, it actually seems to suggest that we are going to see a mass default across the Chinese property sector. But this is a scenario that we believe it's highly unlikely because credit fundamentals in the sector, it has generally improved, with most Chinese developers stepping up their deleveraging efforts. Of course, at this point, we do not rule out further defaults, especially amongst the smaller and the weaker developers. But we think that default risk in the sector should be manageable. And also on the policy front, we think that the worst of the crackdown is probably behind us because the Chinese government has recently shifted to pro-growth policies. For the property sector, the government has already delivered some supportive policy measures by ensuring that healthy developers have continued access to bank lending and mortgage approvals. And just last month, the government announced that they are going to make it easier for property developers to access the funds that are being held in escrow accounts. So historically, Chinese developers, they are allowed to sell residential projects before completing them. And for all these pre-sold units, consumers will pay the full price of their homes. And all this money actually goes into an escrow account. So in theory, developers, they are only supposed to use these pre-sales funds in the escrow accounts to pay for construction bills related to that specific project, or when they have delivered the apartments to the consumers. So in theory, this was supposed to be the case. But in practice, in the past, developers usually treat it as free cash to be used for things like debt repayments. So last year, the government suddenly clamped down on the use of all these pre-sales funds to pay their debts. So a lot of developers suddenly find that they don't have enough cash to meet their debt obligations. So now the government is relaxing the rules. The government is now allowing the developers a bit more flexibility in using the funds to repay their debt obligations. So this is a shift in the right direction. We think that the government is slightly easing off on its policy crackdown, and we believe that a lot of the negatives have already been priced into the market. And the current valuations of Asian high-yield bonds, it more than compensates for the risk that investors are taking in the sector. And based on recent events, I think there is also increasing evidence that the worst of the regulation is probably behind us. And this will be a huge catalyst for Asian high-yield bonds to outperform this year. Okay, so yep, that's all for our market allocation for 2022. And right now, I'll just move on to talk a bit about some of the portfolio changes that we have made for our MAPS portfolios. So we have made a number of changes. We have actually downgraded a couple of fixed income segments over the past few months. So the first change that we did was to downgrade emerging market bonds to an underweight position. So like I said just now, for EM bonds, they have seen a significant decline in yields and spreads over the past 2 years. And this segment is currently giving investors a yield of about 5%. So you can see that relative to historical levels, it is actually not that attractive. And when we downgraded this segment towards the end of last year, the yield was actually close to about 4%. So not attractive from a yield perspective for EM bonds. And on top of that, credit spreads have also tightened very substantially over the past 2 years. So when I say credit spreads is essentially a measure of the compensation that you are getting for taking on additional credit risk. So this amount of compensation that you are getting from EM bonds has fallen very sharply, and investors are receiving less and less reward for the same amount of risk that they are taking in this sector. So that means that means that moving forward, there is actually not much room for price appreciation for emerging market bonds. And like I also mentioned just now in my slides, the problem with EM bonds is that they come with very high duration. So duration when I say duration, it actually means duration is essentially a measure of your interest rate sensitivity. So generally in a rising interest rate environment, the prices of fixed income assets in general, they will drop. But those assets with a higher duration, meaning that these are the assets with a higher sensitivity to interest rate movements. So you realize that assets with a higher duration, they are expected to drop a lot more compared to assets with a lower duration. And you can see from this chart over here that the duration of EM bonds is actually a lot higher compared to the duration of, let's say, Asian high yield bonds, as well as your US high yield bonds. And also its yield, it's not comparatively higher. It's about 5%, which is lower than what you can get from US high yield bonds. And like I said, for Asian high yield, yields are actually very attractive at this point, and a lot of negatives have already been priced into the market. So over the past few months, we have actually decided to reduce our exposure to EM bonds, and we have actually reallocated that exposure to Singapore-centric short duration bond funds, which tend to hold up well in a rising rate environment. So second change that we did was to downgrade Asian investment grade bonds. Given our conviction that inflation is likely to persist into 2022, and our expectation that the Fed will hike interest rates rather aggressively, then investment grade bonds, they are likely going to be very vulnerable. So this thinking also applies to Asian investment grade bonds, which is also quite sensitive to interest rate movements. So valuations of Asian investment grade bonds, they are also not particularly attractive at this point. And more importantly, if you look within the Asian fixed income space, high yield bonds are actually a lot more attractive compared to investment grade bonds. When I say high yield, I mean Asian high yield. Like I mentioned, Asian high yield bonds has been reflecting a lot of negatives already. At current levels, investors are very well compensated for the risk that they are taking in the sector. So we have downgraded our exposure in Asian IG, and we have actually allocated this to Asian high yield bonds. On the equity side of things, we have upgraded Japan to an overweight position. So I've already talked a lot about our investment case for Japanese equities for this year. So I will not go through this like in detail. But in short, our investment case for Japan is that number one, Japan's vaccination rate has been accelerating. So that actually paves the way for a more sustained economic reopening. And also number two, policy is going to be supportive, especially when you consider the fact that the fiscal stimulus package that was announced by the government. So this will be a tailwind for the economy this year. And Japan's inflation situation is not as serious compared to the Western developed markets like US and the UK. So the possibility that Japan will hike interest rates very aggressively this year is very, I would say, very low at this point. And last but not least, I think market valuations for Japanese equities, they are also attractive relative to the US equity market. So in terms of our inter-asset allocation for 2022, we are actually overweight equities relative to bonds. And the rationale behind this really is that we think equities can have the potential to do well this year, even against the backdrop of a rising interest rate environment. Bonds will be more vulnerable since they are typically quite sensitive to interest rate movements. And also in terms of valuations, bonds are quite expensive across the board and offering quite limited value to investors. But in the equity space, the valuations of most equity markets are still pretty reasonable. So it is because of these reasons we remain overweight equities relative to bonds. And also in terms of our intra-asset allocation for fixed income, as I've highlighted in my previous slides, we have downgraded both investment grade, Asian investment grade bonds, and we have also downgraded our outlook for EM bonds. So we have an underweight position for these two fixed income segments. And additionally, we have raised our exposure to Singapore-centric short duration bonds. And we have also upgraded Asian high yield bonds as well. So we have an overweight position in these two particular segments. In terms of our intra-asset allocation for equities, we have upgraded Japan to an overweight position. And that also means that we have trimmed our exposure to US equities, which we believe at this point is quite expensive and offering very limited value to investors. And we also continue to maintain our overweight positions in Asia ex-Japan, as well as China. And before I conclude my presentation, just wanted to share very quickly my views on the latest escalation in tensions between Russia and Ukraine, and whether that has changed our market views for this year, and how investors should position themselves in light of this rising geopolitical risk. So at this stage, we are not calling for a risk-off stance in our portfolio allocation. So we will still maintain our overweight position in equities, given that we are still in an environment of robust earnings growth. And of course, in the short term, there will definitely be a negative impact on sentiment, but there is actually very little direct trade between Russia and the world outside of Europe. So if you look at it in terms of economic impact, the impact will likely fall mostly on European economies. And after years of sanctions since 2014, actually trade and financial links between Russia and Western countries, it has been going down over the years as well. So at this point, we don't think that the economic impact from this crisis will be strong enough to cause a global recession. And we must also not forget that China is easing its policy at this point in order to stabilize its economy. And most Asian countries, they are moving towards endemic COVID. So opportunities still remain in the equity space. But I think what is more important at this point is the indirect impact of inflation through higher energy and food prices. Because Russia and Ukraine, they are two of the world's largest grain exporters. And Russia itself is also a major energy exporter. So this crisis, should it escalate even further, it will further push up commodity prices, and that will add more uncertainty to the global inflation outlook. In general, it's actually very hard to predict the direction of geopolitical crisis, and it is also very difficult to price geopolitical crisis. And like I mentioned just now earlier, they also tend to have short-term shocks to equity markets, and at the same time, they also have the potential to rebound very quickly, as we can see from the V-shaped recovery in global equity markets during the annexation of Crimea in 2014. So this sharp sell-off and the sharp rebound took place within a very short period of time. So instead of trimming our equity exposure at this point, I think our portfolios should be positioned for a trend of rising interest rates. So moving forward, we'll probably be looking to diversify our portfolios and tilting our portfolios towards parts of the market that can outperform in an environment of higher interest rates. So some of these examples include value stocks, which has been outperforming this year relative to growth stocks amidst expectations for higher interest rates. And with interest rates expected to go up further, then value stocks could be something that you can consider having inside your portfolio. And of course, financials and I think commodity-related stocks are something that we could also potentially consider having inside our portfolios at this point. So just to wrap up, here's a summary of what I have shared today. So for 2022, we think investors should be overweight equities relative to bonds. Within equities, we are overweight Japan, as we think that Japan has the potential to play catch up with its global peers this year. And we are also particularly bullish on China, given its attractive valuations and also the recent shift in policy towards a more pro-growth stance by the Chinese government. And within fixed income, we think investors should go for short duration bonds. And we also think that Asian high-yield bonds are giving investors very attractive value at this point. Okay, but of course, market risks have been rising. Dominating the news right now is Russia and Ukraine. Inflation and the number of Fed rate hikes this year, I think that is also another uncertainty lurking around in global equity markets. And don't forget about Omicron. So far, the economic damage done by Omicron has not been that serious. But if there are any further disruptions to supply chains, then that is going to keep inflation at high levels across the world. So all this means is that market volatility is likely to remain high, at least in the short term. And the best way for us to navigate this uncertain environment is to really have a diversified investment portfolio. And for MAPS, we will, of course, continue to assess ways to diversify our portfolios in the months to come. And also, like I said just now, I think our conviction right now is for interest rates to hit even higher, especially with this recent escalation in tensions between Russia and Ukraine. So we think we should be positioning our portfolios for higher interest rates for the rest of 2022. Okay, so with that, thank you so much for your time today. And I hope you take care, because cases in Singapore have been rising. I hope everyone will stay safe and healthy during this period of time. So thank you very much. And right now, I'll just hand the time back to Sarah.
Thank you, Aaron. So we hope this webinar has given you good insights into how you can position your portfolio for 2022. So with that, we have come to the end, and thank you and stay safe.